Less money on Wall Street. That is right. A new report says bonuses for Wall Street traders may drop as much as 15% this year. The key reason, a decline in second quarter revenue and profit. Estimates from compensation consultant Johnson Associates says bond traders could see a drop of between 5 and 15%, while equity traders may see up to a 10% cut. Those numbers are down from the firm's May estimates. Concerns about the European debt crisis and the volatile markets all took a toll on Wall Street's performance during the second quarter. Well, for more on this story, I'm joined by Bloomberg News reporter Christine Harper, who has been reporting on this story and sort of the implications for Wall Street. And first off, is it just about the second quarter numbers here? Is that what's behind this?
Well, really, everybody waits throughout the year to find out what's going to happen with revenue, because that determines what happens to their bonuses at the end of the year. And the first quarter was gangbusters, as you know, the perfect trading quarter. These companies made a lot of money, so hiring was up and pay was looking like it was going to be up. That's what we saw in the May report from Johnson Associates. But in the second quarter, things really turned. You saw a lot of the results fall. So that's behind the adjustment in the outlook for the bonuses, really. It follows revenue.
So does that mean that it could be reversed, though, in the coming quarters?
Okay. I mean, but then there's a lot of questions about how people see the future, the second half. Is it going to be a turnaround, or is it going to be a decline? And that's why hiring trends on Wall Street are also interesting to watch, because if you see, as we have seen this week, Credit Suisse, Barclays announcing some job cuts, that's a sign that there's going to be, they are at least seeing it a little more pessimistically than they were earlier in the year when pretty much all of these firms were hiring.
So it sounds like the chances of a reversal or the declines being less than this are probably pretty slim at this point.
Well, I mean,
right?
Of course, none of these firms are perfect forecasters, and we've seen many cases where they've overhired and then had to pull back, or even pulled back too far and then had to hire quickly. So you can't necessarily say, but it certainly says that a few of these firms on Wall Street are becoming more pessimistic and pulling back their reins, and we may see more of that. It's going to be interesting to watch whether an increasing number of firms kind of slow down their hiring programs or start laying off people.
Right. And aside from that, though, I mean, the fact that we're talking bonuses here, right? We're not talking salaries yet, but we're talking bonuses. Of course, that's very important on Wall Street. But, you know, a 10 to 15% drop, is that enough to start getting these people to say, let me get out of this firm, I want to move on to somewhere else? Well,
the Johnson Associates report also showed that other areas, the outlook for bonuses are worsening. Hedge funds and private equity, which had a much bigger, better outlooks for bonuses in May. Now those bonus estimates are still up, but not as much as they were. So those are traditionally the places where traders might go. And while maybe it's a little bit of a better prospect than being at these big Wall Street firms, it's not necessarily amazing. So it's going to be interesting to see how they view their options.
And we were actually talking with the CEO of Stifel Financial earlier this week, who was saying, look, you know, with all this uncertainty going on, you know, even I'm not hiring anymore, or at least I'm slowing down my hiring. So, you know, you heard all this stuff before about, you know, Wall Street, these guys are now going to go to these mid-sized firms because of all this regulation. And even these mid-sized firms are now saying, well, you know.
Exactly right, Betty. And what's happening as well is at the beginning of the year, of course, you heard people talking about how the financial sector was doing well, the rest of the economy really wasn't. There was this big disconnect. Now it looks like it's kind of catching up with the financial community, that the slow pace of economic growth is leading into less trading activity for them. People are less willing to put their money in the equity markets. That's hurting the returns of these banks. The only bright spot, of course, is retail banking, where
I saw that. Yes,
credit costs and charge-offs came down in the second quarter, so the revenue in those units was better, and some of the bonus outlooks for that area is improved versus May. Although, of course, a lot of people are suspicious whether those charge-off levels can be maintained throughout the year.
Okay, so a lot of questions here, maybe some uncertainty even on this front.
Absolutely, always.